Welcome to the Sage Planning Solutions Podcast. Join us as we help you navigate life's financial obstacles and find financial freedom. We will cover the major pitfalls that can derail your journey to financial independence. Get ready to learn, grow, and prepare for your best possible financial future.
Securities and advisory services offered through Cateray Grant & Company Incorporated, a registered investment advisor and member FINRA SIPC. Cateray Grant and Sage Planning Solutions are separate and unaffiliated entities. The information provided here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Any opinions or forecasts contained herein reflect the subjective judgments and assumptions of the authors only and do not necessarily reflect the views of Cateray Grant & Company Incorporated. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. This information is not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Neither Cateray Grant & Company Incorporated nor its registered representatives or employees provide tax or legal services. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice.
Dr. Mike, we're finally glad to have you on the show. We've been looking forward to this for a while, and we're excited to dive into our conversation today.
Absolutely. Good to see you guys. Appreciate the opportunity to talk some markets.
I thought we'd lay out some topics our clients and investors are concerned about, and those are in no particular order: the state of the current bull market, a potential recession, credit card debt and delinquencies, local and national inflation, just to name a few. Just wanted to get your thoughts on that. We can start off with the state of the current bull market. There's been a lot of bull market deniers. We just celebrated the 2-year anniversary of the bull market. From your experience, where we're at in today's market, where do you see this market going? And do you think we are going to stay in a bull market for the intermediate long term?
I really like what you said there. I feel like you've been getting a little bit of a read on some of our pieces we put out, because I just wrote a piece this week on that 2-year number that you mentioned. So since October, I think it was 12th, 2022, that was the bottom for that year, and we've gone up 68% since then in the S&P. And the entire time, folks have been calling for a recession that has never come. At a high level, I would say, we at Horizon and me personally as well have always been a lot more optimistic than that. The data has continued and over that time frame, of course, strongly supported that run. It's just, in my experience, it's never a good idea to bet against the U.S. consumer. And that consumer strength and the healthy labor market contributed significantly to, pretty strong economic growth over the last couple of years. And quite frankly, where we sit today, I really like where the market is. For one reason, when you look back historically, folks always or typically get nervous about investing around market highs, right? They're like, oh, the market just hit a high. I got to wait for a pullback before I get in. Well, if you look historically at those types of relationships, the market peaks are a great time to invest because you have strong momentum and the market continues to surprise all the naysayers that are calling for recessions and bear markets, because those things make for great headlines, but not necessarily do they present themselves at all times.
That's a great point. This is a concept that I've been talking about for about 8 or 9 years, and I think he's come to grips with it, is that in new all-time highs, which I think this year we've hit 42 or 43 new all-time highs in the S&P 500, there's no sellers. So nobody's looking at breaking even and getting their money back. We've been programmed in the financial services industry to think, oh, it's an all-time new high, we should probably be selling now. Whereas that's probably the beginning of newfound momentum. And if we were to sell now from the peak in 2022, January, we're only 22 or 23% above that peak. So in reality, if we were to end a bull market today, it'd probably be one of the weakest bull markets, in my opinion, and shortest.
There's actually just so many good things happening in the markets right now. And let me caveat that with the next 3 to 4 weeks aside. I don't think anything major is going to happen over the course of the election and leading up into that, because there certainly is some uncertainty. Although, typically after the fact, you do see a pretty significant reduction in volatility, and markets like it when there's less uncertainty, right? So I think the next few weeks could be a little rocky, but then after that, there's no reason we can't just continue the grind higher. But other than that, the GDP growth has been very strong this year. We've had a couple quarters of over 3%. The current quarter is still reading over 3% when you look at estimates from the Atlanta Fed. The Fed is starting to cut interest rates. And then we saw the hot jobs number earlier this week. The labor market's still quite healthy, but yet they're still probably going to continue to bring interest rates down because inflation is pretty much under control, right? It's in the ballpark of their 2% target. Any surprises we've had have not been significant. And so you've got basically a really healthy labor market, strong economic growth, and the Fed cutting interest rates. And then we've even seen from the banks, earnings season starting just the last couple of days. Earnings have looked pretty good, and there's a lot of market participants that are calling for kind of a low bar into earnings season. So we've got the potential for upside surprise. And I think nothing bad really happens in the market when you have strong, healthy earnings, a strong consumer, and a Fed that's cutting interest rates, right? Those are all three very constructive things. And of course, we're going to continue to have things like the geopolitical risk overseas as overhangs, as well as the uncertainty around the election. But these things will be resolved at some point. The election, hopefully in 3 weeks, we'll know. I say hopefully because it's possible that we don't know right after the election. But with that reduction in uncertainty, I mean that should be a real good thing for the markets. So I think absolutely this can keep going on. And I haven't even got to talk about AI yet. So but let me pause it there and see what you guys think.
The first thing that jumps to mind is that naysayers about the markets to this, the markets to that. These are typically, I think, the people, institutions that were kind of on the wrong side of the trade. Those who feel like the market is too high or a stock is too high or whatever, a sector, they're typically doing things quietly. You don't ever really hear what their thoughts are. They're just kind of doing it. Great example is Warren Buffett selling back his position of B of A over the last 3 months. And no one knew until a week and a half ago. The other thing that you said the underpinnings, and you named 3 or 4 sort of key components to that. I love that because it's when you look at when do bad things happen, it's not typically when you have like structurally everything set up like it is now. There is a curveball I'd like to throw at you just to kind of get it out of my head now. Because I've been holding on to this for 3 days, Mike, because I wanted to ask you this.
Yeah.
I'm not a kind of person who's going to worry in future trip too much about what could happen. But if Israel and Iran, if that conflict intensifies and 5% of the 94 million barrels of oil a day that is needed globally, if 5% of that goes off the market, what does it do to, I'm not really worried about the U.S. because they're a net exporter, but I am more worried about the global economy. What do you guys, when you sit down and sort of have your powwow, do you say, if this does happen, if this escalates, if it goes to this, here's what we're going to do, right? And I think there's typically 3 or 4 answers that people are used to hearing. But I'm sorry to put you on the spot, but I would love to know what your feedback is on that.
No, I mean, I think that's what this is for, right? To put me on the spot. But look, I mean, the short of it is behind, like when we have our investment meetings about, calling a situation like that, we recognize the fact that we have no edge in predicting if there's going to be an escalation of the war or not. I mean, you even saw, I believe it was just last night, oil has fallen $3 or $4 a barrel just on the announcement that there's not going to be any direct attacks on nuclear or, energy producing facilities in that retaliation. And so, in general, though, I will say like long energy and long oil is a pretty good geopolitical hedge. Right, because if you do have that escalation, that is where that's going to be felt first. I mean, that said, in our implementation of that, we would not use oil futures or anything like that. There's a lot of carry costs that go along with that, but more kind of small allocations to like direct energy sector companies. A small allocation can go a long way because energy, like in the when you look at like overall S&P or just global markets, energy does not make up a significant portion of those indices. So like a little bit can go a long way. And so in this environment, we prefer to be just relatively neutral on that exposure, not overweight nor underweight, simply because we recognize the fact that we have, sure, we can read the news like everybody else, but we have no real edge in predicting if that's going to escalate or not. And so, as a result, we just try to remain relatively neutral to that. And that may not be the case all the time, right? If there was not a lot of geopolitical overhang, we may not have any energy position, but we just want to kind of punt on the possibility of that simply because we see it as a total coin flip and have no ability to predict it. Make sense?
Okay, thank you. Yeah, absolutely. It's funny, you look at if you have an informational advantage, that's one thing. If you have some, inside knowledge, that's another. But the third is like, how are you going to do it? without breaking the bank, because the cost of these contracts and the carry cost is, as you manage, it's prohibitively expensive. And if you're wrong, you're not going to make up for that anytime soon.
Yeah, you're right. I mean, we prefer to focus on things that we feel like, to your point, that we do have an advantage, whether informational or analytics wise, and sometimes you hear folks, in just the financial media talk about these situations with more confidence than is realistic. So I'm here to tell you from our perspective, I'm admitting that we do not know how to predict that. And therefore we just use that as an opportunity to neutralize the risk as opposed to take some, major over or underweight allocation.
Where do you feel like you have an advantage? Where do you feel like this is what we do a little bit better than most other places on the street?
Yeah, I mean, so broadly speaking, I would say just asset allocation in general. We have a really solid team here that's a lot of fun to work with, where we have several different, disciplines represented. So, for example, myself, I'm a PhD in finance, run our research and quantitative strategies team here. So I'm a little more data science driven, but we have several team members that have a really deep, history and experience in, macroeconomics and Fed policy, currencies, and that sort of thing. And then quite a few folks with a pretty deep expertise in derivatives-based markets. And you can get a lot of really interesting information out of derivatives-based markets, looking at positioning and where folks are kind of, over or underexposed. Because when you have big moves in the market and you have like a whole swath of investors like on one side of an option trade, then, you can get these, investment banks and dealers of these options rehedging their books, driving significant, very quick price action in one direction or another, simply because people got a little, over their skis as far as how they're positioned. And so looking for opportunities like that and, really systematizing a lot of our processes is where we think we have a big advantage. If there's, some type of anomalies or situations like this that we are trying to exploit, we've got a really deep bench over here and team that can really systematize that into a set of rules that will allow us to implement that in a very efficient quantitative manner. And because it's systematized, we're able to, constantly enhance and kind of tweak how we're doing things and just continuing to make the system better, and so that's kind of where, that kind of multi-discipline type approach is kind of where I think we have an advantage in the markets.
You mentioned data science, and Dominic went from 6 to midnight. What are you passionate about personally right now?
Yeah. Personally, I mean, one of the things I've been really interested in overall is just like in the ETF market, you've just seen this massive dump in the market with derivatives-based strategies and, stuff that was not available in, an ETF or fund wrapper 10 years ago. And so there is a huge swath of new funds that are heavily utilizing derivatives to do everything from enhancing returns, right, increasing beta, or driving income, or providing a defensive bias. That's what I've been really interested in, is to see just there's been some really good launches and there's been some really like question mark. You're like, really, I'm surprised that a firm is coming out with a strategy like this. So I think that's one of the things that's been interesting to me.
Yeah, the alternative space is starting to grow, and I believe that the alternative investment space is the future of investing. It's huge in Europe, it's huge in Asia, and they've been investing in alternative assets such as structured products for decades. We have too, but that's a big portion of what they do over there is alts. And you're right, a lot of shops are opening up different ETFs, and you got a question like, okay, what? It's going to cost more than a mutual fund.
Yeah, I mean, look, I don't want to get into name dropping firms, but there's definitely been some launches where I look at it and I'm like, what the market really doesn't need is a product like this, right? Because like it's extremely challenging to understand. It's inherently risky, and these things are being like heavily sold and marketed, not bought. You know what I mean? But yeah, I mean, look, one of the other things like along these lines too that you've seen over the last several years is, I'm sure you guys have heard of the zero DTE options, right?
Mm-hmm.
And
can you explain that in layman's terms for our listeners?
Yeah, it's 100% lottery ticket on the market from the beginning to the end of the day, right? And so there's no gray area. It's a real binary outcome type of derivative, but it's basically a derivative that literally has 0 days to expiration. Like today is the day that it expires. So by the end of the day, we're going to be in the money or out of the money. And typically, prior to the existence of these, options, started about a month in horizon is, typical, right? So not only do you have to be right on the direction of the market, but you got to do it in the next month. And then, about let's see, 15 years ago, we got weeklies. So you got Fridays in the S&P, and then back around 2018, you got Tuesday, Thursdays. And then right before COVID, I think it was, just a couple years ago, you got an expiry every single day of the week. And now, look, admittedly, that's quite convenient. I mean, we utilize options with not just Friday expiries, but it is quite interesting when you look at some of the research from like investment banks and the dealers in these options that like over 50-60% of the daily option volume is occurring in these options that expire at the end of the day. That's just a significant amount of volume that's based on literally just like adjusting marketing positioning. It's not by, the retail community, right? And it's quite interesting, and it can cause some really knee-jerk reactions in the market. It really can, because you get folks that are a little over their skis one way or the other, and then these things get rehedged very quickly. And, that can cause a lot more noise than signal when you're trying to parse out like what the market is telling you.
It tells you a lot about the state of our industry when you're trying to squeeze every last drop out. You're trying to squeeze out drops that may not even be there. One of the things that Dominic and we try to explain to people, Wall Street has this funny thing, which is how well might they do in, let's say, a mutual fund that they manage. That team says, hey, we already hit our growth goal, and it's the end of September. Great. Let's shut it down. Let's lock it in. Let's do our tax loss harvesting. Let's do what we need to do. But we don't want to put our compensation in jeopardy, right? And when we look at how much, this is an industry that is entirely dependent on people responding to incentives, personally, as well as, for the company that you work for. But at the end of the day, it's all going to be personal incentive. And so when we look at these 0 days to expiration options, it's just sort of like tells you the story. Listen, a lot of these firms out there are really not looking after you at all. And one of the things that we take some pride in is that we work with people who you grew up next to. We work with people who might be your mom and dad's best friends. We work with, and that's where the rubber meets the road for us, because we have so much responsibility. And sorry, I'm preaching to the choir here, but it's like sometimes we look at what gets all the noise on financial news, and we're like, man, this has nothing to do with Mr. and Mrs. Main Street America. It has absolutely nothing to do with them.
Yeah, I mean, I couldn't agree with you more. I think you guys know the Horizon story, but just for all your listeners, I mean, the main thing that we're trying to do is we create what we call goals-based solutions, right? So outcome-oriented solutions that are basically meant to just reduce the complexity of the investing landscape out there. And so we'll build, various models that have a very specific defined outcome to them, whether it be, an accumulation goal, whether it be, a protection or risk mitigation goal, or whether it be some sort of income target. And if you can really, what we found, if you can really clearly outline the purpose of a strategy and explain it in terms that an end investor can really internalize and understand why it's working the way it's working, that'll really help folks stay invested when things get volatile. Because look, we are investing in markets. Things will get volatile at some point. It's not a matter of if, but when. And what I've seen in my experience far too many times is when people are in products that they don't understand, and you get a period of market volatility, which is always around the corner, you can end up just kind of a natural behavioral bias selling out at the exact wrong time. And then you're very slow to get back in because you're being extra cautious. And all you've really done is you've basically gotten over your skis as it relates to your risk appetite. You've locked in a loss, And that can really throw off your investing plan, right? So it's just really important to us that we clearly define expectations for strategies and make sure that we can explain why the particular strategy is built the way it is and like what we're actually trying to invest for, because it'll make it much more likely you'll be able to stick to it when things get messy.
Love it.
Yeah, another topic I wanted to speak about, we talked about debt, consumer debt or government debt. One of the ratios that I look at on a regular basis is debt to GDP. And that ratio has been increasing. That curve is steepening. And one of the things I was reading is that the U.S. deficit is projected to widen 10% of GDP by 2054. Just wanted to get your thoughts around that.
Look, I think that we have seen, we have seen an expansion in, that metric, and that metric does get a lot of airtime. But there's no reason necessarily that it can't continue to grow. As long as our economy remains healthy. I think the more extended that gets, the more, kind of house of cards, the whole kind of economy becomes. It gets a little more on shaky footing. I do think that spending is something at the federal level that needs to be addressed. I mean, I think currently we're probably running like $3 trillion a year or something in deficit spending, right? That sounds about right. And when you take into account like future liabilities, like that's expected to continue to grow. And I think that, that is definitely like a longer term overhang that we need to get a better control over. It just doesn't make much economic sense why you should allow that to just continue indefinitely. Like at some point that's going to be a problem. But I will say, it's hard to predict when it's going to be a problem. Nobody exactly knows. There's not one number that says, okay, now you've gone too far, because we can, again, as long as the U.S. dollar remains the reserve currency and everybody's transacting in dollars and our economy is stable, that can continue to extend for probably longer than a lot of folks are comfortable with. But at the same time, it's not in a good direction of travel, right? You would want to see some stability there. And we haven't quite seen that, in the recent trends. So I don't think it's a today problem, but it could be a problem in the future. It's just really hard to predict, when is too much.
Yeah, right now the cost to service our debt is about 3% of GDP. It's expensive. That just means that money's just being siphoned off just to pay debt. Again, that ratio continues to increase. Is there a probability, because I know one of our other partners, Brad, is always concerned about de-dollarization. He's also concerned about the BRIC countries creating their own level of currency and trading between each other and really getting away from the dollar. We've seen that story time and again, and it's never worked out well. What are your thoughts surrounding de-dollarization and these BRIC currencies and trying to step away from the U.S. dollar?
When it comes to the U.S. dollar and our place in the global economy, I don't think there's hardly any data that you can point to suggest that that's really under fire. Besides maybe random esoteric data points. There's just a significant volume of transactions occur in the U.S. We have one of the most well-functioning legal systems that allow for how to deal with legally when things don't go as the contracts require them. And when you look at other potentially competing currencies, what people always like to talk about China. That's just not the system. They don't have that system and judicial system in place that we do that would allow for any significant volume of global activity to be directed towards, because there's no recourse if it doesn't go your way. And so just the free open markets that we have in the U.S. and the fact that it currently is such a large dominant reserve currency. It's here to stay. And I think any kind of, fear mongering that, there's going to be massive de-dollarization is unfounded, quite frankly. But yeah, these are good topics, questions that come up from time to time for sure.
The other one that I know I've been having quite the conversation with is on the debate stage, and that's price gouging. And just looking at consumer staple companies, looking at their profit margin, looking at their supply chain costs. I'm trying to make sense of the corporate price gouging that's been a big part of this election. How would something like that look? Because again, I'm looking through numbers, I'm balance sheets, cost of goods sold, and I'm trying to make sense of it. Can you help us make sense of that? Is there price gouging happening in your opinion? I just can't find it.
I think there's probably pockets of it that are referenced on a broad economic scale. No, I don't think so. I think it's just natural free market activity. When it comes to putting like price caps and stuff in place, I mean, you start to get into a dangerous territory when you start having, for example, government interaction, putting these strict caps in place on, consumer related products. Perhaps there is some price caps in some areas that may be beneficial. I think that that's very much the exception, not the rule. And I think it would be quite dangerous to go down the path of having the government set prices on things. We've just seen that not work on numerous different economies, on numerous different underlying goods and services. And so look, it's a dangerous thing to go down. I think right now as well, like with as much, just think about like companies reporting earnings, right? And they come out and they talk about all the things that are working in their business. There's a lot of accountability at a corporate level. I think that if there was blatant price gouging going on, and you had something, for example, like we just had really bad hurricanes out here, on the East Coast, and we're in Charlotte, North Carolina. So up in the North Carolina mountains, I'm sure you've all heard of that, right? Like price gouging in that scenario would be, hey, these people are in need. Now everything's a lot more expensive. That, of course, would be a very bad outcome. I just don't think that just the general public would accept that from a company that was blatantly doing that, and that it would self-select itself out of the market as being a competitive actor. And I think that type of price control is what you want, because that's the free market saying, hey, I don't want to deal with this company anymore because they drove up prices during a time of need or whatever it was. And just to be clear, I don't have any examples of that happening. That is just an example of something that would be price gouging that I personally think the market would fix on its own.
Yeah, the price of being caught with that would just be disastrous.
Right. I mean, like you get a little bit extra profit at the expense of like nobody wanting to have anything to do with your brand anymore. So, and just the fact that news and information is available. I mean, think about it. Most of the news that you get nowadays, you get on your Twitter account in like 2 seconds, right? Or Reddit or whatever internet forum. People believe this is what is in front of them. That kind of stuff would not stand in this day and age, in my opinion.
The smoking gun, right? If you were caught red-handed with the smoking gun, it's an existential threat to anybody. I mean, Congress would then get involved, and that would be that.
I think it would lead to the creation of black markets, shortages. Just like when things get more expensive, people look for an alternative to be cheaper. And when you put in price caps, it would probably lead to reduced quality. Also, I think long-term supply declines. And if I'm not mistaken, you can correct me because I know you probably know a little bit more about the pricing history than I do. But I think the Nixon administration was the last administration that we seen price caps, which led to negative effects.
Yeah. I mean, admittedly, I'm not a historical expert on those sorts of policy, but it is definitely just in just a basic economic context. It is a constraint that doesn't need to be there. Rarely do constraints materially improve things, and so I think that it's just a dangerous road to go down when you start putting price caps in place. I think the more appropriate thing to do is to put rules and regulation that just have like natural consequences, so the free market can act as free as it needs to be, but then let consumer behavior through that interaction and through those rules and regulations sort out the companies that have strong brands and people want to do business with, and sort out the ones that they don't.
Can we talk a little bit about debt?
Yeah, credit card debt, total household debt, these sorts of things.
Consumer loan, junk debt, bank loans. We were reviewing the slide deck from Stephen's quarterly conference call here a few weeks back, and he was talking about sort of like this wall of maturities coming due in 28 and 29 in all 3-4 sort of major areas of debt. And it was not what I expected, but they sort of went through there, and interest rates kind of on their current trajectory. Steve seemed to have very little worries about it.
He's very little worries.
Yeah.
Yeah, I mean, I would agree. This is a topic that we've talked to our clients a lot about, because you You hear about it. So every quarter, the New York Fed puts out the credit and debt report that has all of these metrics that get referenced, whether it be like total household debt as a percentage of disposable income, all sorts of these ratios broken out and tranched out by type, whether it be mortgage, auto, consumer loan, credit card, etc. And what I have seen is kind of like a popular clickbait on the internet is quoting, big changes in these levels and ratios from a year or 2 or 3 years ago. You're like, wow, the last 2 or 3 years, we've seen a big increase in, these various, debt service ratios. But if you actually take that same chart and you just like zoom out, right?
Yep.
Like the starting place matters significantly. So, we basically, in a lot of these ratios, have come from like the lowest, and when I say low in this case means the healthiest levels that you've ever seen historically. And yes, we are up off of those massive lows, but we're basically back to trends like right before COVID. And prior to that, these debt service ratios across a number of measures were quite a bit higher. So yes, the recent short-term change has been up. But you go from it's just kind of like mortgages, right? Mortgages 3 years ago are the lowest they've ever been in the history of the existence of. And then, now we're sitting in the 6.5% range. And yeah, it's higher, but it's actually pretty darn normal, when you look over a much longer time period. And so, just think about, there's a lot of reasons the housing market has behaved the way it has, but I don't think anybody would have predicted that the housing market and prices would be as stable and strong as they have been, as a result. And I think that's just because the starting place matters. And right now we're just kind of back to normal in a lot of these measures.
Unfortunately, buffoons get to put out these accounts to get clicks, and they spread what they spread, right? But I do like the context that they're
as Pat Bennett says regarding interest rates and equity markets. Since the financial crisis, we've been extremely spoiled for a long time.
Oh, yeah.
And a 6.5 mortgage is actually more the norm. If you zoom out, like you said, 40, 50 years, it's not unheard of to have a 6.5% mortgage. I remember in 2004, when I was working in private banking, that was literally the mortgage rates that I was offering. And some people had 7.5%, 8%. Or variable mortgages, and they were happy to refi for 6%. I clearly remember that. Also, I think in terms of debt, people are worried about this potential cascade effect because consumer credit card debt has reached $1 trillion, and that's a number I think as of beginning of the current year.
Yeah, but at the same time, look at consumer just balance sheets, and that's a fancy way of saying how much money people have. Net worths are at all-time highs. You should proportionally see an increase when you're talking levels, and yeah, I've seen those numbers. And again, what a great clickbait article, right? $1 trillion in credit card debt sounds scary, and yeah, those are big numbers, but yeah, there is a significant amount of wealth that's been generated, in the economy over the past 5 years as well, and so. Again, when you zoom out, a lot of these ratios looking at income or wealth as a percentage of these various metrics of debt, things look very healthy. And I think that a lot of that is, again, kind of overblown when you look at the big picture. But one of the things you guys talked about a second ago, I don't think that we addressed, but the maturity wall type stuff. Could you go back to that?
I would have to go back to their slide. That slide that they referenced in their webcast was not included in the slide deck. And it basically showed, here's your BAA and below, here's your high quality, and then here's your bank loan debt. And it basically showed, it was a bar graph, and it showed in 27 and 28, that's where the mass maturities were. And so when those reset, if they're going to reset it, where interest rates were a year and a half ago, pretty bad. But they were sort of feeling like, hey, with the trajectory with interest rates right now. So it was a backhanded way of getting you to admit something was good for our listeners. It was it's something, again, if I had the slide, I would show it to you. I'd have to log into it, watch it, do a screenshot, and then show it to you.
Yeah. I mean, I wrote a piece about this just last week on not that specifically, but looking at credit spreads, so high yield credit spreads. Just for kind of description of what that is. So you have like an index of high yield bonds, which is basically just a collection of a whole bunch of different high yield bonds, very similar to the S&P 500 index. But, in that index, it's a bunch of individual stocks. They have very similar measures for a bunch of bonds. And, a high yield spread would basically look at what kind of yield are you getting for this high yield bond and taking on this risk, minus the yield of a similar duration or maturity treasury instrument. It's considered risk-free. And so that spread is a really commonly referenced metric for, looking at just overall risk appetite, is a direct measure of the cost of financing for, non-investment grade companies. And we have been hovering around all year. And the reason I wrote the piece just last week was because we reached the lowest level that we have in the last 3 years. And so you're basically, these high yield spreads are a little under 300 basis points. The actual total financing cost for these companies is going to be that spread plus whatever the risk-free rate is. All in, it's around 7% or so. But when you think about this area of the market, since a good portion of that is made up of a spread, that part of the market is going to be less impacted with changes in just that underlying risk-free rate. And again, zooming out, it's pretty normal. So companies, years ago when there was a ton of issuance because interest rates were really low, companies are taking advantage of that because you're at literally like generational lows in borrowing activity. But we've seen interest rates significantly higher and companies continue to operate at very high levels. So maybe it's not as favorable as it used to be, but it's not a problem. If that makes sense.
It sure does.
Yeah, I've talked to Pat about because I do a bunch of ratio analysis. And one of them is the high yield index divided by the long-term treasury index. And as long as that is rising, it's confirming the state of the equity markets. And right now the spreads aren't, the spread can continue to widen and by a good margin, and we'd still be in a healthy uptrend from what I see.
Yeah, I agree.
When our clients think of interest rates, it has nothing to do with spreads, right? I said TED spread, that was inaccurate, but it has a lot to do with, it has everything to do with, if I want to buy a house, what's my cost of money going to be? If I want to refinance, if I want to HELOC, all these consumer things that you get through consumer banks. And it's funny because you'll hear people say something like, man, rates are at 6, what a ripoff. You're like, there's no such thing as a 2 handle anymore in your lifetime unless the shit has hit the fan, right?
Right.
And we go through something again. It's like we are who we are. Our appetite for cheap money, when you were indoctrinated, maybe because you were lucky enough to buy a home during a depressed real estate market and you got your money with a 3 handle, good for you. You won. Walk away, be happy, go do other stuff, enjoy your life, because you just can't wait around for that kind of stuff. So it's just kind of funny. The things that we hear is a lot different than the things that you hear. Right.
Yeah. But to your point, I mean, the I feel like one of the things we've looked at before is just the all-in cost. People typically buy homes on a monthly payment, right? Like how much can I afford on a monthly basis? And so one of the things that we've written about in the past and tracked through the post-COVID periods is if you take like the national median home price and you take current mortgage rates, you can easily calculate what the median home price monthly payment is. And make no mistake, it's roughly doubled, over the last 5 years. It's very expensive from that measure. And you're seeing that affect a lot of the younger folks. I think I'm in my 40s, so I don't qualify as younger folks anymore. So, think like the young 30s and under that want to buy a house. It may be quite difficult from an affordability standpoint to do so because of that metric, and I think that the housing market has been such an interesting economic price series to track through this COVID period because of what's happened to rates, and yet prices continue to go higher. And of course, that's driven in large part to the fact that interest rates today are well above the average interest rate that people that already own homes is, right? And so these folks are not refinancing. And as a result, the total amount of just, existing home sale activity is significantly lower than it used to be. And the fix for that is going to be people just naturally resetting and having to move. So time. And then, of course, having mortgage rates come down a little bit and make the gap between that average effective rate and what the current mortgage rate is. The closer that gets to parity, the better affordability will be overall, and especially for the younger folks that are yet to own a home.
Yeah, it's when finance meets Main Street. That is it.
Yeah.
It goes back to that saying that people don't buy properties, they buy interest rates, or in this case, they buy payments, which is the same thing.
You don't buy the price, you buy the payment.
Right. But one other thing on the mortgage rate side of things. So there's really two major components that are going to go drive mortgage rates. One is like what the similar maturity treasury yield is, right? That's the natural risk-free starting place. And so for a mortgage rate, it's really common to look at mortgages compared to a 10-year bond and look at that spread. And that spread, is actually driven more from volatility than it is the overall level. And so what I mean by that is, a mortgage rate is basically a 10-year bond yield plus this spread. And right now, you do see this spread has been through the course of the last couple of years quite elevated compared to the historic norm. So typically, maybe mortgage rates are about 150 basis points or 1.5% above a 10-year yield. That's what they typically are. We've been, north of 2.5 to 3% in the last several years in the market. So what that means is now that we're getting some clarity on Fed trajectory, that's going to be just literally reducing uncertainty in the interest rate market. And with that, you could see mortgage rates fall, even if overall interest rates do not fall that much, simply because that spread is not, goes from 250 basis points back to 150, right? And so even if you don't see a change in the 10-year yield, you could still see, a percent or so come out of mortgage rates just as interest rate risk gets reduced in the overall market. And that's a pretty big driver that, has the potential, to get us back in the mid fives on mortgage rates, even without major changes to future interest rate policy.
There's a gentleman named James Abadi who I think he and I were separated at birth. He's much cooler than I am, though. And he was talking about, we were basically talking about when the Mag 7s stop buying chips because their CFO say, guys, shut it down. We're not making any money on this investment. Yeah, it's cool. You have some cute little whizzy things that you get to do with your iPhone. But outside of that, we need to be able to monetize. At some point, when you look at the distillation tower, if you will, of AI chips and how they're supposed to be used and how they could actually be turned into profit, what do you see out there that you're excited about? And what do you see as this is where the Facebooks of the world, the Alphabets of the world, the Apples, the Google, where do you see them making money with AI chips?
Yeah, I mean, the AI theme is, I believe, and this is Horizon's view as well, but is just kind of like a generational productivity enhancer. Yeah, very similar to what the internet was in the 90s. And I think we've currently just seen really I would call it the first phase, where you basically have the main beneficiaries have been the actual chip producers, the NVIDIAs of the world. And, you see these price to sale ratios on NVIDIA. Some people still argue that it's undervalued because they continue to grow revenue at such a strong clip. But, that said, one of the main things we're looking for is for that theme to broaden out, and you look at, you saw a little bit of that with the third quarter utility stocks, some of the best performers. One of the big drivers there, right, is the fact that these data centers that are using these AI chips, they need enormous amounts of power. And I think it was probably a month ago at this point, there was the announcement that Constellation Energy and Microsoft had entered into a deal to restart 3 Mile Island. The reason they did that is so that Microsoft could power its data centers with a nuclear plant. I mean, to me, just let that sink in. There's an entire nuclear plant needed to fund a data center that uses AI chips. I mean, if that's not real adoption, I don't know what is. That's just a crazy headline to me to hear that, because, it costs billions of dollars to bring a nuclear plant back online.
When's the last time a nuclear power plant was brought back online?
Yeah, it's been a very long time. I should know this because my dad was a nuclear engineer for 40 years for Duke Energy, but it's been a while. One of the next kind of like phase 2 type companies that we're looking for are things like aerospace and defense, industrial robotics, biotech, biotech especially, these pharma companies that are doing a lot of this, have to run millions and millions of tests and computer simulations to see the interaction of all of these various drugs. Like these types of companies, I think, can see enormous benefits from an AI productivity standpoint, and we haven't seen it really hit yet. And so that's definitely one of the main things that we're watching for is these kind of like phase 2 beneficiaries and seeing that AI influence and productivity kind of broaden out beyond just the chip makers of the world.
Years ago, I was sitting, it was called the Stanford MIT Venture Lab, and they were talking about nanotechnology. Who was the CEO of AOL for some time? Was it Scott Case? Am I saying that name right? And he was basically at this panel and he's saying, guys, you're not going to make money off of this stuff from end users for decades. First, someone has to make the tools. And when you can make the tools, then you can make the product. But it's going to be so far down the road because you're working on something right now that you can't really see. Right. And so where did the nanotech story go? Turned into vapor. Right. And so you look at what happened when the internet came around and everybody got banked. If you had the sexy thing behind your name, what was it? .com. A lot of companies got banked. And now you look at no one quite knew what the internet was, and it's surpassed everybody's wildest dreams in a lot of ways. But you look at how many of those companies went away. I used to work on Great America Parkway, and there was all these gleaming buildings, and 80% of the companies, probably more, 80% of the companies that were in probably 2 square mile radius, they're all gone. And like only the lucky survive. So I look at this kind of stuff and, you look at the gold rush, who made all the money in the gold rush? Here in California, we could name 3 or 4 family names that made all the money. Other than that, no one really made, their fortune. Who made their fortune was the guy that sold the picks and the axes. And so when you bring up the NVIDIA story, at some point we're going to say, oh yeah, remember NVIDIA? Remember when they were the hot dot? What's the next logical progression from chips? You said, the assimilation of aerospace and defense and biotech. What do you think these tools are going to do? What are they going to provide? Yeah, I mean, it's just straight up more efficiency. It's more productivity, which means a greater amount of output per employee. Gotcha. I don't really subscribe to the fact that AI is going to take jobs away. I think it's going to make people that have jobs have various levels of potential productivity enhancement based on what their role is. Here at Horizon, I mean, full disclosure, we are very actively utilizing these tools. Right now, I'll tell you what, we get enormous benefits for summarizing large amounts of text and earnings transcripts and assimilating that very quickly into something that we can make more sense out of. Because of a lot of the quantitative stuff we do here, we have a lot of programmers on the investment management side that are designing strategies and writing algorithms and testing them. And the ability for these AI tools to basically like write code and clean code for you is just massive. And so you can take what might used to take like 3 or 4 guys to program something up, one can do in half the time. That's the kind of stuff that is going to make a really big difference. And it's going to have it's not going to be the same effect in every industry. Like some industries and some types of businesses are just more conducive than others to be impacted by those productivity enhancers. And that just has some really interesting consequences when you look at like what the market looks like in 10, 15 years, once you have started to see this seep into all of these various industries and how they can fully optimize and utilize this technology, because it is extremely powerful for certain tasks. And I suspect that as time goes on, the number of tasks that it can be helpful with will just continue to increase.
I think the artificial intelligence is going to increase improved decision making, like you said, which I think is a big one. And then the healthcare advances. That's something Pat and I talk about all the time. Biotech is one of the themes that I've been focusing on for almost a year now. because I believe that AI will get there, and then increase profitability just because it's going to reduce labor costs and improve the operational efficiency. Those are some of the things that come to mind. And then you had mentioned Constellation Energy. One of the things that I was thinking about back in late May was these AI systems are taking up so much energy. There's going to be a side effect to the utility sector. And I had read something about Constellation Energy being in talks with Microsoft. Next thing you know, that thing's taken off to the moon. Am I going out too far by saying that some of these utility companies could potentially start acting like tech stocks?
I don't think they're going to start acting like tech stocks. I think that it's reasonable to expect that you get a boost in performance because of the extra demand. But utility company, despite the enhanced demand from an energy standpoint, is still under a lot different regulatory environment than a tech company. And there's a lot of constraints in place. They typically pay hefty dividends, so they're not reinvesting into their business at the same rate that growth-oriented tech company works. And so because of some of those structural differences, no, I don't think you're necessarily going to see utility stocks starting to behave like tech stocks. But what this kind of AI theme provides, it provides a catalyst for the price of that utility stock to absorb the market's expectations for future demand. And so it provides tactical opportunities, right? And you saw that with, we wrote a note about a month ago, the hottest sector year to date as of a few weeks ago was utility stocks. You're like, what, not technology? And the answer is no, not technology. It's actually utility companies. But, there's also other things that have been going on that have helped utility stocks. I mean, one of them, is interest rates have come down a lot, and utility stocks paying large dividends tend to trade like bonds in some respect of the equity market. But then also you saw huge pop with that Constellation Energy news article that came out. And so you're going to see more and more things like that, and that'll provide those tactical opportunities. But at the end of the day, utility stocks ultimately are still going to behave like utility stocks because fundamentally their businesses haven't changed. It's just the demand for their what they're selling has.
Yeah, it looked like the bond market and the utility market were front running the Fed just based on their behavior.
Yeah, absolutely. And to be honest, it's not a surprise to me that you've seen rates back up. Heading into the Fed meeting, I think one of the biggest surprises out of that for like the average investor that maybe doesn't follow the market every single day was you actually saw like longer term interest rates up after the Fed cut rates. You're like, what's going on? And I think it's really important to like go back to like what those long term interest rates are accounting for, and they already account for the market's expectations of future rate policy. So if we took look at a 2-year bond, right, you're basically in a 2-year yield, you're getting the average Fed funds expectation over the next 2 years, plus a tiny bit of term premium for the fact that it's a 2-year bond, not a 3-month bond. And so it's a really good kind of estimate for like what the average Fed funds rate might be over the next 2 years. And similarly, when you go out to a 10-year bond, it's the market's expectations over that 10-year time period, plus, a slight premium for the fact that you're locking your money up for 10 years. And so you basically had, heading into that Fed meeting, you already had the market basically pricing in like maximum amount of dovishness. Prior to that 50 basis point cut we got, the market was pricing in that you were going to get 10 cuts between that September meeting and next September, which is basically a cut a meeting, and one of them has 2 cuts. And that's what was already in the price. The only way that you get rates lower than 3% is if you have a recession. And I don't believe we are anywhere close to that. So to me, that means that we were already at basically like max optimism about what the Fed's going to do. So no surprise that rates have backed up since then.
I don't want to get too deep in the weeds on that topic. I like it. And if Mike had like some coloring books and some crayons that he could give to me to say, Pat, we're going to explain to you why that is the way it is, I would happily listen into it. What I'm appreciating is that we're not talking about the bottom of the barrel topics that rise to the top of every news feed and every news broadcast. That we're talking about constructive foundational elements of the economy. I guess one thing that's popping around in my head, one of the things that I look at, Tom and I have talked about it a lot over the years, is that a lot of the old tools don't work anymore. A lot of the old, like, well, this is what you do in this situation, like those things are sort of off the table now. And the guys on CNBC, God bless them, they got a lot of airtime to fill. But when they talk about inversion of the 210 spread, or when they talk about, hey, typically when this happens, it's recessionary, and I get it there to kind of fill dead airspace. What are some of the things that you kind of look at and go, man, this is stuff that we were born and raised on, but it doesn't really have that much significance anymore? And there may not be an answer to that. It may be, I don't know. But what's one or two of the things that, we don't use that anymore? Or what are one or two things, like here's one thing that we really look at that 10 years ago, 5 years ago, we never did?
I think there's a layup answer to that. Traditional valuation, I think, is flawed in the sense that it doesn't fully account for a lot of future drivers of growth. And if you subscribe to, I'm just going to buy deep value stocks because they have a value premium and they're priced low relative to their earnings, you could get absolutely run over by the market for years on end, because there's a lot of things that aren't in that earnings number that are in that price number, and it's just not able to capture that. Now, granted, there's a lot more intelligent kind of ways to look at valuation, but the traditional low book value, low P ratio approach, just that ain't enough anymore.
It hurts my heart because Intelligent Investor, remember the book? It was all about, and that's how I cut my teeth. But you're right. It's just, you could make little money for a long time buying a quality household name, a blue chip stock that, hey, if you love it at 10, well, you might love it at 5 because it just isn't making money like it used to, because things have sort of moved on. And price reflection, it's priced there for a reason.
Exactly. I mean, and the technology advances and things like AI that are going to be in a nonlinear way absorbed into different industries, they're only going to make that more difficult, right? Because you don't really fully know what that like earnings growth expectation number should be. But the market price knows it, and that's why the stock is priced at whatever it is. And so, I think that's one thing. Another thing that I think is relevant along those lines. So myself, as an academic, there's a guy by the name of Eugene Fama who got a Nobel Prize years ago, University of Chicago. Him and another co-author had some very famous papers written in the early 90s on basically the value and size effect. And so these guys are consultants with DFA, and DFA has built their all of their strategies around a lot of these factors. And they've made plenty of advances since then. But since these early 90 papers, all of the rave was about, hey, you need to own small cap value stocks. Like, that's where all the risk premium is. Well, now that that's been well published and everybody started doing it, guess how much premium is in small cap value stocks now? It's all gone. It's been arbed away. I mean, everybody's been doing that for years. That, you can look at these Nobel laureates and their wonderful research, which was true at the time that they wrote it, but markets change, dynamics change. And I don't think that small cap value effect is as strong today as it was 30 years ago because of all the structural changes we've had in the market. And in a lot of cases, just the rise in passive index investing has just made that a lot worse as well. Now that you have companies becoming such big components of these well-tracked indices that are out there.
Yeah, talking about the CAPM models and size factor, value factor, like the Fama French, is that that you're referring to?
Yeah, that's exactly right.
Like the Fama French 5-factor model. Yeah, like you said, it was good for the time, just like some of the best money managers of the 80s were, they had the longest track record. Yeah. Well, there's a lot more inefficiencies then than there is now. So you can look at intrinsic value and look at market value and find an anomaly. I don't think they would have the same success today as they did back then. For example, I think it was
buy-sell programs. You can't compete with.
You can't. Like Peter Lynch, he's great, but he wouldn't be able to do what he did then in today's environment.
Agreed.
Mike, we appreciate you coming on. All the conversation has been very insightful, and we'd love to have you on again, probably after the election, just to see how things pan out.
Yeah, sounds good, guys. I really appreciate it. Fun talking to you.
Thanks, Mike. Right. We love it, man. Thank you so much for your time.
Thanks a lot. Bye.
Take care.
See you, buddy.
Thanks for listening to the Sage Planning Solutions podcast. Be sure to subscribe so you don't miss the next episode. If you want more information, visit our website at sageplanningsolutions.com.